Fear and greed, two emotions that move trillions of dollars every single day and control every decision you make, whether you know it or not. They've built empires. They've destroyed fortunes. And according to Daniel Kahneman, the Nobel Prize-winning psychologist, they might be the biggest reason most investors never become truly wealthy. Because the problem isn't the market, it's you. Every chart you see, every crash, every rally, every bubble is not driven by logic. It's driven by emotion. Fear and greed are not abstract ideas, they're biological survival mechanisms that evolved long before money even existed. When you feel fear, your brain activates the amygdala, the region responsible for fight or flight. When you feel greed, it triggers your dopamine system, the chemical that makes you crave more. These are ancient impulses designed to keep you alive in the wild. But in modern markets, they're silently making you poor. The illusion of rational. Daniel Kahneman and Amos Tversky discovered that people don't make decisions based on logic, they make them based on emotion, and then justify them with logic. That's the foundation of behavioral finance. You don't buy a stock because it's objectively undervalued, you buy it because it feels good to believe you're right. You don't sell because of cold analysis, you sell because your gut twists at the sight of red candles on the screen. In Kahneman's words, we are not thinking machines that feel, we are feeling machines that think. The fear-greed cycle. Zoom out. Look at the history of every major market event. The dot-com bubble, the housing crash, crypto booms, meme stocks all follow the same cycle. Optimism excitement is not just market behavior, it's human behavior apt over time. When greed dominates, people stop asking, what if I'm wrong? When fear takes over, they stop asking, what if I'm right? That's the emotional pendulum that defines every investor's journey. Prospect theory. And Daniel Kahneman's prospect theory explains why losses hurt more than gains feel good. That pain of losing $100 is psychologically twice as powerful as the joy of gaining $100. So when the market drops, fear becomes overwhelming and the rational brain shuts down. You sell at the bottom, then later, greed pulls you back in and you buy again at the top. The cycle repeats, not because you're stupid, but because your brain is wired that way. Kahneman's warning. Kahneman's research wasn't meant to make people feel smart. It was meant to make them aware. He warned that the mind's natural biases, overconfidence, loss aversion, anchoring, make rational investing almost impossible without systems. In his view, emotionless investing is not about being cold or robotic. It's about designing structures that protect you from your own psychology. Because the most dangerous trader in the world is the one inside your head. Fear is the market's most powerful emotion. It spreads faster than data. It multiplies faster than logic. And when it takes over, even the smartest investors, hedge fund managers, analysts, traders turn into terrified animals trying to survive. Because when you see red on the screen, your brain doesn't think, is this a correction? It screams, run. The biology of fear in finance. In 2007, neuroscientists used MRI scans to study traders' brains during simulated crashes. They found that financial losses activated the same brain regions triggered by physical pain. That's right, losing money hurts. It's not a metaphor, it's literal. Your body releases cortisol and adrenaline, the stress chemicals that prepare you for danger. That biological panic drives irrational reactions. Selling too soon, freezing and doing nothing, or worse, trying to win it back. This is why people sell great companies at the worst possible moment, not because they decide to, but because they can't stand the pain anymore. The herd instinct. Fear is contagious. When one person panics, everyone else does too. It's an ancient survival mechanism. Humans are social learners. If the group runs, you run. Because thousands of years ago, not following the crowd might mean getting eaten by a predator. Today, it means selling your portfolio during a market dip, not because you analyze the data, but because your brain says, if everyone's leaving, something must be wrong. Kahneman called this availability bias. Your brain doesn't evaluate probabilities, it recalls vivid examples. So, after a crash, the memory of fear lingers longer than the facts. The feedback loop of panic. Here's how fear feeds itself. Market drops slightly. You check your portfolio. You see red, your heart rate spikes. You open social media, everyone's panicking. You sell to protect yourself. Prices fall even more. Others see more red. They sell too. This is not analysis. This is collective emotion disguised as strategy. In truth, most market crashes aren't purely economic. They're psychological. They're feedback loops of fear amplified by mass behavior. Kahneman's view on panic. Kahneman observed that investors don't evaluate outcomes objectively. They focus on recent experiences. When fear dominates, they overweight short-term losses and ignore long-term probabilities. This is called recency bias, your tendency to believe that what just happened will keep happening. That's why when the market falls for a week, you start believing it'll fall forever. Your brain projects the present into the future. The fear paradox. Here's the irony. The best investment opportunities often appear during maximum fear. When everyone is selling, prices drop below value. That's where the money is made. But fear blinds you to opportunity. It tells you, wait until it's safe again. And by the time it feels safe, the opportunity is gone. That's how fear quietly steals wealth from millions of investors, not through destruction, but through hesitation. Kahneman's advice on fear. Kahneman's solution wasn't to suppress fear, it was to anticipate it. He believed awareness is your best defense. If you know how your brain reacts under pressure, you can design systems that override those instincts. For example, setting automatic investment plans, setting stop-loss limits, avoiding real-time market monitoring. Because in a moment of fear, discipline beats intelligence. Fear doesn't disappear as you get smarter. It just disguises itself better. The real mastery comes when you recognize fear's voice and choose not to obey it. Because markets don't destroy wealth, emotion does. If fear is pain, then greed is pleasure. It's the invisible drug that keeps investors coming back, even after losing everything. Greed doesn't feel dangerous. It feels exciting, powerful, even deserved. It whispers, you earned this. You're smarter than the rest. But Daniel Kahneman warned the moment you start feeling certain about your financial genius, you've already made your biggest mistake. The dopamine trap. Every time your investment goes up, your brain releases dopamine, the same chemical that activates when you win a game, receive a compliment, or take a drug. This reward signal conditions your behavior. It teaches you to chase that feeling again and again. You start checking your portfolio more often. You crave confirmation. You convince yourself the rise will never end. And slowly, without realizing it, you stop analyzing the market and start chasing dopamine instead of data. The greed illusion in psychology. Greed is rarely recognized as greed. It hides behind phrases like, I'm confident in my strategy. This time it's different. I know what I'm doing. Kahneman called this overconfidence bias. We overestimate our knowledge and underestimate uncertainty. He famously said, confidence is a feeling, evidence. Yet in markets, confidence feels like control. And when money's flowing in, that illusion becomes irresistible. You stop questioning your decisions. You interpret luck as skill. You double down. And eventually, you cross the invisible line between ambition and arrogance. The rise before the fall story is filled with examples. The tech boom, the housing bubble, the crypto euphoria. Each began with optimism and ended in regret. In every case, the pattern is identical. Investors make profits. Confidence turns into certainty. Caution disappears. Risk becomes invisible. The bubble bursts. And yet, every generation repeats it because every generation believes they are smarter than the last. That's greed's greatest trick. It doesn't look like danger, it looks like success. The psychology behind the high in neuroscience. This is known as reward prediction error. When an outcome exceeds your expectations, your brain releases an intense burst of dopamine. You feel powerful, like you've figured it out. But here's the twist. Once you experience that high, your brain wants more. Not the same reward, a bigger one. So you take more risk. You ignore red flags. And you keep pushing, even when logic says stop. That's how greed turns smart investors into gamblers, not because they want to lose, but because they can't stop wanting to win. Kahneman's view on euphoria. Kahneman warned that success blinds judgment. He observed that after a few good decisions, people start believing in patterns that don't exist. They start thinking, I was right before, so I'll be right again. But the brain doesn't record luck. It records emotion, and every positive outcome strengthens the illusion of control. This is why Kahneman often said the most dangerous phrase in investing is, "I know what's going to happen next," because once you believe that, you stop preparing for what might happen instead. The greed feedback loop fears how greed traps investors. You make a profit. Dopamine hits, you feel good. You want that feeling again. You increase your risk. Luck runs out. You lose. Fear returns and the cycle resets. Fear and greed aren't opposites. They're partners. They feed each other endlessly. Greed pushes you into risk. Fear pulls you out in panic. And the market profits from both. The hidden cost of greed costs more than money. It costs clarity. It clouds perception. It makes you ignore the one truth that defines all financial success. You cannot control the market, only your behavior. Kahneman's research reminds us that humans are not rational investors, we're emotional creatures trying to survive uncertainty. Every crash, every bubble, every meltdown is just humanity repeating its oldest habits in a modern form. Greed doesn't announce itself with warning signs. It feels like progress. It sounds like confidence. It looks like success. And that's exactly why it's so dangerous. What if the real danger isn't the market, but the mirror we refuse to look into? Daniel Kahneman once said, "The confidence people have in their beliefs is no measure of their accuracy, only of how coherent the story is that they've managed to construct." And that's where the real problem lies. We don't invest in data, we invest in stories. Stories about safety, stories about success, stories that make chaos feel predictable. But the market doesn't care about your story. It only responds to behavior. Step 1. Recognize the emotional loop. Kahneman believed awareness is the first defense. He called it slow thinking, the deliberate, analytical mode of the brain that questions instinct. When you feel panic creeping in, pause. When you feel euphoria rising, pause again. Those two pauses between fear and greed are where real investors are made. Every time you hesitate before reacting emotionally, you reclaim a fraction of control from the chaos. That small gap between impulse and action, that's the space of rationality. Step 2. Accept uncertainty. The human mind craves certainty, but markets thrive on uncertainty. We are wired to hate randomness, so we build illusions, charts, patterns, predictions, opinions. But Kahneman's research shows the more confident you are in your predictions, the less likely they are to be accurate. His experiments revealed a paradox. Experts, with decades of experience, often performed no better than random guesses when predicting market movements. Why? Because the world changes faster than our brains can adapt. So instead of fighting uncertainty, embrace it. Let it remind you that humility, not confidence, is your real advantage. Step 3. Create rules. Not reactions. Greed and fear are powerful, but predictable. They follow patterns like tides. Kahneman often spoke about the need for systems, pre-made rules that guide decisions before emotions strike. Rules like, I'll only invest what I can afford to lose. I'll sell if a stock drops below X. I'll never trade based on emotion or hype. These are not exciting. They're not dramatic, but they protect you from yourself. Because when panic or greed take over, logic disappears and systems are the only thing left standing between you and disaster. Step 4. Remember you are the bias. The hardest lesson Kahneman ever taught wasn't about others, it was about us. We love identifying bias in other people. We rarely notice it in ourselves. It's easy to call others emotional investors. It's harder to admit that our own fear, greed, and pride drive 90% of our choices. That's why Kahneman warned, the idea that the future is unpredictable is undermined every day by the ease with which the past is explained. We are storytellers by nature. We explain losses as bad timing. We call wins good judgment. And we never stop to realize that both are often luck. When you finally accept that, you start investing differently. You stop trying to predict the market and start managing your reactions to it. The Kahneman way. Detachment over emotion. Imagine a pilot flying through turbulence. He doesn't scream. He doesn't panic. He follows instruments because he knows emotion won't save him. Discipline will. That's how Kahneman wanted investors to think. You cannot remove fear or greed. You can only observe them without obeying them. Investing, at its core, isn't about conquering the market. It's about conquering yourself. Fear plus greed equals balance. Aries the irony. Fear and greed aren't enemies. They're two sides of the same coin. One protects you, the other pushes you forward. The goal isn't to eliminate them, it's to balance them. Fear keeps you from overextending. Greed motivates you to take necessary risk. Without one, you'd never act. Without the other, you'd never survive. Kahneman's brilliance was showing that both are useful as long as you remain the master, not the puppet. At the end of his career, Kahneman often reflected that knowing your biases isn't enough to escape them. Even he admitted that decades of research hadn't made him immune to his own psychology. That humility, that recognition that we never fully outgrow our irrationality, is what separates wisdom from arrogance. Because the goal isn't to be perfect, it's to be aware. The market doesn't punish intelligence, it punishes ego. It rewards patience, humility, and the rare ability to stay calm when the world loses its mind. Kahneman's warning wasn't about fear or greed alone. It was about the stories we tell ourselves to justify both. So the next time you feel the rush of a win or the sting of a loss, remember, you're not fighting the market. You're fighting your own mind. And the few who learn to master that battle never need luck again.